Debt Service Coverage Ratio mortgages, or DSCR loans. It's a key financial product that many real estate investors use. The underwriting for this mortgage is really unique in that the lender underwrites the property and the cash flow that it generates rather than personal financials of the individual borrowing the money. That means personal income, current debt levels, and in many cases, even a credit score doesn't matter. If you're putting enough money down and the property cash flows, getting approved is surprisingly simple. Now in this video, I'll explain how DSCR loans work, how they're priced, and what you should do first before pursuing this product. So let's dive in. The key to understanding DSCR loans is found in the name itself, Debt Service Coverage Ratio. The debt service is the total monthly recurring payments on the property, excluding things like basic utilities. Think of this as your traditional mortgage payment, which includes principal and interest for borrowing the money and your monthly allocation for property taxes and home insurance or your escrow account. It also includes any required monthly HOA dues. To use mortgage lingo, debt service is the PITIA, which is principal, interest, taxes, insurance, and association dues. Now the coverage refers to the market rent, or the revenue the property generates each month. And ratio, that compares the debt service to the coverage, the mortgage payment to the rent, to get a ratio used for underwriting the property. You might be used to traditional mortgages analyzing someone's debt to income ratio, which compares the total debt to the total income. In most cases, individuals can carry as much as 45 to 50% of that income in total monthly debt. With a DSCR loan, none of that matters. In fact, you could be unemployed, have a mountain of debt which would get you denied for most any type of loan like a mortgage or a car or even a credit card. In the case of a DSCR mortgage, the equity in the property and the cash flow it generates are the key ingredients for the approval. Lenders typically want to see a debt service coverage ratio between 1 and 1.25. The math is pretty simple. You're going to divide the rent by the mortgage payment. So a 1-to-1 ratio means that the rent is at least the same as the mortgage payment. A 1.25 ratio means the rent is at least 25% greater. So here's an example. If the property rents for $3,000 per month and your PITIA, or all-in monthly payments, is also $3,000 a month, the math's pretty easy. Right? $3,000 in rent divided by $3,000 of a payment is a 1.0 ratio. Now, if your rent was 25% more, or $3,750, that ratio becomes 1.25. Your investment experience, property equity, and personal credit score all play a role in determining the allowable ratio and cost structure. Mortgage loans have always been priced based on the associated risk. The higher the risk, generally speaking, the higher the rates and the tighter the guidelines. Tighter guidelines in this case could mean a larger down payment or a higher coverage ratio. In other cases, investors may just charge higher rates and fees. When getting DSCR quotes, know that the rate offered will always come with a disclaimer, a really big one, specific to everything we just mentioned. An example might be a rate with a point structure and a requirement of, get ready for this, 20% equity, a credit score of at least 660, a coverage ratio greater than 1.15 for an experienced investor owning at least 2 properties over the past 3 years, on a single family home with a 2-year prepayment penalty. Wow, that was a mouthful. And as you can see, just asking a lender for a rate, it isn't quite how it works with this program. Now, before I tell you how these mortgages are priced, it's important for you to know that there are many mortgage investors offering these types of loans in the marketplace, yet very few mortgage companies have embraced this product. To get the best rate structures, you really need to deal with someone who specializes in this space. You can always reach out to me directly, and if I'm not licensed in your state, I can just connect you with someone who is. And also, if you found value in this video, please be sure to hit like and subscribe to this channel. When DSCR loans first came out, they were very expensive. Not only were the rates high, but the points required to close the loan I thought were quite excessive. But now that a few years have passed and lenders have been able to analyze the risk better, the costs have come down quite a bit. They've even added popular interest-only options, and they allow borrowers to deed the property in the name of an LLC. When shopping rates for DSCR loans, there are 3 things to focus on: the rate, the points charged, and the prepayment penalty. Points are upfront fees that you pay the lender as a percentage of your loan amount. So 1 point is 1% of the loan amount. So let's say $3,000 on a $300,000 mortgage. In most cases, the more points you pay, the lower your interest rate can be. Now, prepayment penalties, that's something that most consumers haven't heard about for quite some time, especially in residential lending. Shortly after the financial crisis in 2010, the regulators prohibited prepayment penalties for all qualified mortgages. Given that DSCR loans are strictly for investment purpose, meaning you cannot use this for an owner-occupied home, this falls outside of the QM framework, which gives lenders flexibility to include them. Now, there are many prepayment penalty structures, and each investor can be wildly different in how they calculate them. The questions you may want to ask is the number of years the prepayment penalty exists and exactly how it's calculated. There are many prepayment penalty structures, and each investor can be wildly different in how they calculate them. An example might be a 2-year prepayment penalty equal to 6 months of the interest based on the initial loan balance and mortgage rate. Others might be flat percentages, such as 3% of the initial loan amount. Some even have declining percentages, such as a 5% penalty based on the loan amount, declining 1% every 6 months to a year. The longer the prepayment penalty, typically the better the interest rate. When the lender has predictability in their profit model or confidence in the duration of time that this loan stays on the books, they're more likely to enhance the interest rates and maybe even allow their product guidelines to be more flexible. The DSCR loan is by far the easiest loan to qualify for, but the interest rates and terms can be a little elevated. That's why I always recommend for my real estate investors to compare these options with traditional Fannie Mae and Freddie Mac mortgages. In many cases, you can get an interest rate that's as much as 1 or 2% better with no prepayment penalty. Yes, I know it's more work, time gathering documents to satisfy lenders' requests, but the savings could very well be worth it. And keep in mind, most loan officers push for easy, because easy on you is also very easy on them. So you might have to give them a little nudge to push and see if that more difficult approach with better rates and terms, is that even an option for you, and is it something you want to entertain? If you're interested in building out your real estate portfolio, don't hesitate to reach out to learn more about our DSCR lending outlets. And be sure to share this video with any investor you know who's having a hard time obtaining financing. And until next time, I'm John Downs.